Ladies and gentlemen, good day and welcome to Camlin Fine Sciences earnings call for Q1 FY26. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. I now hand the conference over to Mr. Rajesh Bhayani from InCred Capital Wealth Portfolio Managers Private Limited. Thank you, and over to you, sir.
Good evening, everyone. On behalf of InCred Equities, I welcome you all to the Camlin Fine Sciences Q1 FY26 earnings conference call. We have with us today Mr. Ashish Dandekar, Chairman and Managing Director, Mr. Nirmal Momaya, Managing Director, and Mr. Santosh Parab, Chief Financial Officer. I would like to thank the management for allowing InCred the opportunity to host this call. I now hand the conference over to Mr. Ashish Dandekar from Camlin Fine Sciences. Thank you so much, and over to you, Ashish, sir.
Thank you. Ladies and gentlemen, a very warm welcome for the earnings call of this first quarter. As is our convention, Santosh Parab, our CFO, will give you a brief and run you through the quarter's results and issues, after which both he and Nirmal Momaya, our Managing Director, will be there to answer your queries. So I'll hand it over to Santosh now. Santosh?
Thanks, Ashish. Welcome everybody and good evening. By this time, I think you would have got our investor presentation also and UFR, which was hosted on the website and also on the stock exchange. As you can observe, our revenue have been at 423 crores as compared to 437 crores of last year. There's a slight decrease. The major decrease is because of deep in the specialty ingredients trade sections where there were lower revenues. And of course, two aspects have impacted this lower revenues. One was we had taken an annual maintenance shutdown in the month of April in all our dyes facility as well as Tarapur facility. So both throughput and output were impacted. This is an annual exercise. Every 12 to 18 months, we have to take one shutdown. This impacted the production also, and of course the margins. There was an unabsorbed fixed cost in the month of April of around 12 crores. However, the other two main verticals, which are the hallmark and which has been the growth story of the company, the blends business, which has witnessed a strong growth in almost all our geographies. Vanillin business also has been stable. As you are aware, there are channel stocks lying in the main two geographies of Europe and US, where the anti-dumping duty is there, and there are very fairly attractive prices which are going up. However, we are observing that there are channel stocks, so to maintain the revenues at what they are and the volumes has been a really nice performance. If you have seen, we have also had an increased employee cost. We had paid on-time performance bonuses to our blends business. The blends business, as you know, has been growing at a very, very fast rate, and it was imperative that we reward the efforts of our employees. So one-time performance bonus of around 7.5 crores was paid to the employees, mainly in Mexico and US. We have been strengthening our teams in blends business largely on the sales side, where we have been recruiting salespeople. The new employees have also increased, and that is also reflecting in the increase in the employees' cost. As you can see, the other expenses or the other operating expenses have been fairly under control. We have been able to control it despite the slowness. Some of the plants were not working in this, but the fixed costs are under control. At the end, with the impact of lower production, higher debits, higher unabsorbed cost, and some one-time employees cost, we have seen a deep EBITDA. We have clocked around 19 crores of EBITDA, which is only 4.5% of EBITDA margin. But this is a one-time thing because of the one annual maintenance shutdown taken in the month of April. As far as margins are concerned, the operating margins, and the product sale margins have reduced from 48 to 44%, mainly on account of low production. As you know, these are very sophisticated high temperature plants. When we close and we restart, there is higher consumption of product, and that has impacted around 2 to 3% of our margin. But all other margins we have been holding on. The prices were stable, fairly stable on both the sides, on the revenue as well as raw material side in this quarter. Vanillin business, we had a small dip in the revenues by around 5 crores, but volumes have been fairly almost same. Prices are going up, but in this quarter, because we are observing the channel stock, as I said, the average realization have not gone up as we had expected. The production of vanillin in this quarter was, if we exclude the the closure dates or the maintenance dates, it was around 50% of the capacity utilization which are there. At present, we are running the plant at 60% capacity utilization. So the two main verticals are doing well, and we think that the states will come back. There is sluggish demand. There is Chinese issues all over the world, as you know. And of course, Trump tariff is there. We are closely watching. We know that this can have an impact on our business, especially in the vanillin business. We are concentrating more on US. However, other than that, we don't have much exposure in US. The US income of blends is manufactured in US. It's a local business, so we will not be impacted from that because it's a local business service from Mexico. So, and we have not been selling any other major raw material. Only few crores is sold to US. So thank you. I will now hand over for question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Raman KV from Sequent Investments. Please go ahead.
Hello, sir. Thank you for the opportunity. Sir, my first question is, I just want to understand how much is the one-off for the entire quarter, and can you just break down, like how much was with respect to the employee bonus and with respect to annual maintenance shutdown and etc.
So as I said, I'll repeat the numbers. We had unabsorbed fixed costs about 12.5 crores in all our plants in the month of April, and around 7.5 crores was paid for one-time bonus to the employees of blends.
Apart from this, there was no.
As I said, we also had 2 to 3% of a margin loss because of startup of plants. We had closed the plants to start the plants. The first dosing, the consumption increases. That will be around 2 to 2%. That will be another 7 to 8 crores.
Okay, sir. So, and my second question is with respect to the blends business side. So, in the previous call, you mentioned it's a high teens margin. So, if I am doing the calculation, if my understanding is right, it should have fetched during this quarter around, even if the margin is 10%, around 23 crores of EBITDA. But our entire EBITDA is 19 crores. So, was there any impact on the blend business margin?
So, we have been saying that yes, when the blend business is matured, it does get a higher teen margin. But as you know, there are a couple of geographies which are very mature, especially Mexico, where we have a 17 plus EBITDA margins. In America also, it's around 15%. But there are other geographies like India or Europe and the Vita 4 piece. These are growing businesses where the margins are in the range of 8 to 10%. So the overall margins are not 17, 18, but sub 12, 13.
Okay, sir. So, and my final question is with respect to the vanillin business. So, what were the prices of what was our selling price of vanillin in quarter one, and what are the prices now? And will our realization be impacted with the US tariff,
So
or
in the
is it a
first
pass-through?
so in the first quarter, our average realization was $12.50, and currently it is slightly above that. As we go forward, the anti-dumping duty levied on the Chinese producers for vanillin in the U.S., that's only to the U.S., and it is not applicable in other markets. For the Chinese, it's 280%. For us right now, currently, the tariff is at 50%, which is a moving target because in the last few days, a lot has changed, but we don't know where it will go and settle. So we yet have a very highly competitive position versus our Chinese competitors. So our understanding is that we will be highly competitive, and we should be able to gain market share in the U.S. market. As far as Europe goes, there are no tariffs. There's just an anti-dumping duty on the Chinese producers at 131%, and that continues. And for us, there is no other additional tariff.
Sir, and one just doubt. With respect to Europe, have you started any commercial export of vanillin to Europe, or have you signed any contract for foreseeable export to Europe?
We started sales to Europe, and
Okay.
it is right now Europe is on holiday, so the business starts in September. So we expect to start negotiating for contracts for the next year, for January. So that's expected in September, October.
And sir, in the previous quarter, you gave a guidance of 65 to 70 crores of EBITDA run rate every quarter. So, I mean, this has been a one-off quarter. Can we expect this guidance going forward, or are you planning to revise it?
No, so it's we have not actually guided anything specific. All we are saying is that our vanillin business will work at about the estimated volumes are at about 2,500 to 3,000 tons. This is what we are saying. Expected realizations would be in the $13 to $14 through the year, average for the year. And we continue to hold that as going forward. We continue to hold our blends business growth. So I think overall, that's what we're guiding.
So 20% blends business growth is intact, right?
Yes.
Okay. Thank you, sir.
Thank you. Before we take the next question, we would like to remind participants to press star and 1 to ask a question. The next question is from the line of Chaitya Doshi from InCred Equity. Please go ahead.
Hello. Thank you for the opportunity, sir. I have a couple of questions. The first one is, sir, as observed that CIF US prices for methylene vanillin were around $16 per kg for June. Could you confirm if this aligns with the realization and any, if you can share the price trends if you're seeing in the export markets?
So, I don't know from where, but when we are selling, as you know, we are selling to our subsidiary, and the subsidiary ultimately sells. So, in consolidated sale, when India sells to North America, it doesn't reflect. Obviously, when we get a higher rate contracts in US, we'll sell at with some discount from India. So there are some transactions which could be at $16, but that's not the average realization price at present. There are transactions with $16, but that's not the rule, because the sale is on the basis of quantity also. So smaller the quantity, higher the realization. But when we get an order and we transfer from India, we do discount it and sell at the discounted price to them. So some prices would appear to be very high.
Okay. And so what would be the current retail or end user price range for vanillin in the US market?
Currently, it would be at about $18 to $19.
Okay. And so with potential tariffs on Indian vanillin exports to the US, can you clarify how currently, who currently bears the cost of these duties? Like our company, distributors, or the end users?
It's always the importer. Whoever is the importer has to bear the duty.
Okay. And going forward, how do you plan to manage your, like, in the next, if the 50% tariff is planned on, so how do you plan to go on?
No, whoever is importing our product will have to pay the 50% tariff. And like I explained earlier, our competitors in China are at 280% with the anti-dumping duty and tariffs on China. We are competitive versus that.
Okay. And the last question, what is the current vanillin production level in absolute terms or capacity utilization percentage?
So, during the quarter when we were producing, it was around 50% capacity utilization, as I said in my introduction, and at present we are running at 60% plus.
And when can we expect it to reach like 100%?
It's a market say, right? Because we can reach 100% tomorrow, but we have to match the market
demand. So the demand expectations are that the channel stocks should clear out by the next few months, and the real demand should start showing up. What ultimately is going to be the real demand coming from Europe and US.
Okay. Okay. Thank you, sir.
Thank you. The next question is from the line of Jatin Sangwan from Burman Capital. Please go ahead.
Sir, you mentioned that you had some impact on gross margin also because of your plant shutdowns and also. What's your sustainable gross margin number that we should look at without including the impact of vanillin that will come in, and of course losses of catechol will go away, but let's say sustainable gross margin for you?
It will be in the region of 40 to 45% gross margins. In that range, 2 or 3% up or down will be sustainable. So we are at 44, it could go to 47, 48. It's 2 or 3% up or down from where we are.
So we are saying that we are in the range of our sustainable gross margins.
Yes.
So the last 2 quarters we were showing 50% plus gross margin, that there were some one-offs in that, and going forward gross margin would be around 45 plus minus 2%.
Correct.
And sir, you mentioned that the prices in US for vanillin are $18 to $19. Can you give some color around what are the prices in Europe and other geographies?
So Europe would be about 14 to 15 right now. Like I said, again, there is stock in the channel which is getting cleared. Once that gets cleared, we'll have a clear idea of where this price will go and stabilize. But going by the anti-dumping duties, I think Europe will be at 15, 16, and US should go up further than northward of $30. And the other rest of the world, the market prices are the Chinese prices are between $7.5 to $8.
Got it. And sir, when we say that we will do 2.5 to 3,000 tons of vanillin, so how much are we expecting from US and how much from Europe and how much from rest of the world?
So I would say US and Europe should be at about 1,800 to 2,000, depending on, like I mentioned, about the channel stock, and 600 to 800 will be rest of the world.
And sir, once this channel stocks gets cleared, US plus Europe combined is around 7,000 to 8,000 tons of market. So by when we expect to reach full utilization for vanillin? Because since there is not much capacity available outside China.
Correct. So the estimate is that we should be at about 70 to 80% capacity utilization in FY27, and I think there we'll get a clear idea. But FY28 is what we're saying we should be at a full capacity utilization.
Sure, got it. Thank you.
Thank you. The next question is from the line of Surya Narayan Patra from Phillip Capital India Private Limited. Please go ahead.
Yeah, thank you for this opportunity, sir. My first question is on the impact at the EBITDA level because of the plant shutdown. This is which plant maintenance that you have indicated, sir? And
so is it both sides, Dahej and Tarapur. because they are interconnected. So we took a shutdown in both sides.
Okay. So this is the annual, this quarter, the timing-wise, this is also the annual timeline for maintenance shutdown, or how is it, sir?
Right. So it's basically between 12 to 18 months we've been taking these shutdowns. So last time we had divided into actually two parts. We had not done one single one, but here we had a boiler inspection. So we had to upgrade the boiler. So we took the shutdown for the entire maintenance. So that for the next 12 months we don't need to, or at least for 12 months we don't need to take any other further shutdowns.
Okay. So then the put together, it is a kind of for 2%. So 7-8 crore as well as the 12.5 crore, almost 20 crore kind of impact relating to the plant shutdown and the restarting of the plant. Is that right understanding?
That's right.
Okay.
That's right.
Okay. So now regards the vanillin business. So is it, see, the tariff is also there, which is an uncertain thing currently, but it is high also, 50%. And on the contrary, we are also kind of having a significant advantageous position to the competition. Practically, we are the second player to Solvay to cater to the US and European demand in this current situation. So if that is the case, is it right to think that whatever tariff, whether it is 25%, 50%, whatever the tariff, that will be passed on only, we will not bear anything?
Correct. So, see, the way to view it is that there is an anti-dumping duty and tariffs on our competitors from outside of these two geographies, which is in US it is 280, in Europe it is 130. So, and ours is 50 in US, and in Europe it is the standard 5.5. So there is 131 plus 5.5, we are at 5.5. So we have a distinct competitive advantage over our competitors.
So hence, ideally we should not be bearing this tariff pressure at all, because it is being we are the only second player for US market. So then it is a response.
But yeah, you're right in a way, but what the way you have to look at it is that there's a limit to what you can pass on also, right? Because the competitors come in, if it is more than 280% of what they have to pay, then of course they also come into the market. This becomes viable for them.
So if we try to sell at $20, it becomes a $30 product to the end customer, right? And then suddenly the Chinese will be interested, because then they get more than $8.
Okay. So even if it is passed on to the importer, but we have to bear something because we have to compromise on the realization front.
Correct.
Yes.
Okay. So is it possible, sir, that instead of focusing on the US, given if it is like let's say 50% and likely to sustain this way, so can we manage, since it is a two-player market for the two major regions, so can we focus largely on the European side and vacate the US market for Solvay? And can Solvay cater the entire demand of the US from US?
See, the way to see it is that what will be ultimately the net realization that we get in our hand. Where will it be more lucrative? We will focus more on that. Today, the US and Europe to us, even with the 50%, are more or less on the same line. Maybe US is even slightly better today. Even with a 50% tariff. The realizations will be better going forward in the US than they would be in Europe. So I think it is better as a strategy to keep a balance and to be in the market, because you have customers in both these geographies who are going to buy from us. So the large F&F companies have multi-locational supplies and they expect us to supply in both these locations. And I think it is safer for us to be servicing both of these, even though one may be slightly more profitable than the other, to have a face in front of the multinational customers, which is that we are a stable supplier and we can service them across the world. which only our principal competitor out of Europe and US can do. The Chinese cannot do that. So that's why I think that's a very strong position for us to be in and to take in the market, is to be able to service them across all geographies.
Okay. Sir, since the anti-dumping duty got implemented in the last week of July itself, so when one should think about commencement of the supply deals, the annualized supply deals of vanillin with the large customers?
So generally, these deals are finalized October, November, because from January they need the material. So with the lead times of at least 60 days for shipping, they typically look at September, October to try and finalize these.
Okay. So then,
like I said, we don't know what is in the channel, what stocks is in the channel. But our estimate is that stock also should not, the overhang of that should not go more than 3-4 months.
Okay. So then in that case, from both the angle, from the inventory, left out inventory in the channel level angle, as well as the kind of new contract commissioning, so from both the angles, one can believe that the true benefit of vanilla ramp-up will be seen from the October, November, December quarter, means the third quarter of FY26.
Correct.
Okay. And sir, is there any compulsion for us to sell in the non-US, non-Europe market for vanilla?
Not really. But some of the multinational customers, we would have to give some material at least in those other markets to prove our second supplier source in each of the markets, at least in major markets.
Okay. Okay. Sir, now just see, obviously vanilla is a greater opportunity of the near future. But if you can talk something about your blends business, which has been consistent, and also if you can possibly give some monitorable there, like generally we have been seeing the growth for this business, which has been very consistent. And I think in the difficult times of the European losses and all that, so that was a business which was kind of bearing all the kind of, or observing all the kind of negatives. So now all those negatives are out. So this business anyway is growing consistently. So on the profitability, true profitability of the business will be reflected now onwards, ideally. So what growth as well as what change in the profitability for the blends business that one should see going ahead?
So when you look at, say, different geographies where we are in, and each are at different levels of advancement. When you look at, say, Central America, which is Mexico, we are at an advanced level there where revenues this year should be over $50 million. And EBITDA margins will be in high teens to touching maybe 20. Then you look at the second most advanced development for us is North America, where this year we should probably end up at about between $30 to $35 million, with a 10% to 12% EBITDA margin. Next year, that same thing would be 50 million plus with a very high teen margin. Then comes Brazil, where we are at say this year we should do about 25 to say $28 million. And the margins again there, because it's at lower advancement, will be in the region of 10%. Next year, the same thing will look like at 35 to 40 million, it looks like a mid-teen kind of margin. Then you come to CFS Vitafor, which is at 15 million this year, 16 million, with a margin of between 5 to 10%. Next year, the same thing will be at an advancement to 25 million, where it will be northwards of 10%. So it's at different levels, and the growth, as you see in these different geographies, are all the target is to grow in all the geographies at least at 15%, and some of them more than 15%, so that the average at least comes to 20. And the EBITDA margin evolution for each geography starts going towards what, say, like a Mexico's advancement is.
Sir, it is so for a better understanding about the profitability, generally food additives are also believed to have a margin profile north of 25% also. So whether there is a threshold limit beyond which the margin really expands faster, or how do you monitor whether it is the growth is linked to, let's say, here the capacity is not relevant because it is means with limited capacity, a significant volume can be created. So capacity is not a parameter. So how do you monitor whether it is the people based on which you monitor the business, or it is on what investment level that you monitor the business to expand to certain level?
So basically, the business is defined by gross margin and people.
Okay.
So gross margin average for the blends business is 35 to 40%. Now, in a product mix, in some markets, you may be having a better product mix, which gives you better gross margins. So your EBITDA levels could possibly be higher at some point. The balance is always as to what are the kind of investments you make in terms of salespeople, technical support, and application laboratory people in all these departments, where that drives the sales. So the key drivers of the sales are those people. So, like for example, in this year, say in Q1, we've increased our strength in the US by almost 35% in the last 6 months. So obviously we are investing from the EBITDA in the US. Now the impact of that will come from, say, Q3 and Q4, because it takes 6 months for a person that you got in to start delivering on new businesses.
Okay.
So for us, it's a balance of keeping in mind that what are the gross margins in the market, which are the products, which is the focus area, and what are the people that we require to push more in that focus area. That's what drives the business. Then there are some businesses which are, like, say, for example, antioxidant business, which is where we are fully integrated. That becomes a door opener. Maybe the gross margin for the blend business may be a little lower there, but that becomes your door opener into a market.
Okay.
So again, it depends on the market, depends on strategy for each market, where it is, what is the level of maturity of the market, what is the level of maturity of us playing in the market, what is the product mix, what are the products that essentially where we have significant advantage over competition. It's all defined by a lot of these things.
So then this recent 2 acquisition, particularly even
Sorry to interrupt.
Yeah.
Mr. Surya Narayan Patra, we request you to rejoin the queue, as there are several participants waiting in the question queue.
Sure. Okay.
Thank you. The next question comes from the line of Satish Kumar from InCred. Please go ahead.
Yeah, hi sir. This question is regarding the gross margin. So, what is the gross margin that you estimate ex vanillin? Because when we were not selling vanillin, we were making a gross margin of around 46-47%. So what sort of margin we can expect ex vanillin?
Yes, so that's the margin will continue at that. That's what I mentioned earlier, that we'll be in that range. And vanillin margin, of course, will get defined by ultimately at what price the market settles at. But yeah, it's as it stands today, we are in this range of 45, give or take 3% up or down.
Yeah, so and if the vanillin goes up or down, then it will increase or decrease our margins, right?
Yes, correct.
And so, sir, just to recheck, so when we are selling blends and straights, then what sort of gross margin do we expect? Only in vanillins and straights? Only in blends and straights?
So blends, our typical gross margin is about 40%. And in straight, for the hydroquinone chain, it will be more than 40%. It will be probably closer to 50%. And for the catechol chain, it will be closer to 20%. So that's how the average margin then comes to around 45%.
Okay, got it, sir. Thank you. Thank you, sir.
Thank you. The next question is from the line of Chaitya Doshi from Incred Equity. Please go ahead.
Hello. Sir, I have a couple of more questions. So first one is that how much vanillin have we sold this quarter in the US as compared to the last quarter?
So it was almost the same amount of vanillin which we sold to US this quarter.
Can you give this number?
It's an internal sale actually. You should ask me what I sold to the third party. The third party sale all on consolidated basis was around 540 tons.
Okay. And so the production cost, what is the production cost for 60% utilization?
So 60% utilization, the production cost will be in the range of between 9.25 to 9.75 based on the crude price.
Okay. Thank you, sir.
Thank you. The next question is from the line of Dhavan Shah from Accurate Advisors. Please go ahead.
Yes, sir. So my question is on the vanillin side of the business. I think you mentioned that there is an inventory of roughly 1,800 to 2,000 tons in US and Europe and around 600 to 1,200 tons for the rest of the world. So if you can help us to understand how much is the demand from US and Europe annually, and how much is it from rest of the world? And versus that, how is the supply environment? I mean, we have roughly 6,000 tons of capacity. We are running at 50-60% right now. And Solvay is also there, and the Chinese are also there. So if you can help us to understand, the demand supply dynamics of vanillin at the moment, and by when do you expect this inventory will be over? If you can help us on this part.
Sorry, I didn't understand your question because the inventory, we don't know what the inventory is in the channels in US and Europe. That is unknown to us.
You mentioned earlier, I think in the earlier question.
12 to 14,000 tons. Sorry.
Yeah, sir.
Yeah. So 12 to 14,000 tons is the demand of US and Europe, and about 16 to 18,000 is the demand for the rest of the world.
Okay. And how is the supply environment at this moment? And the inventory, by when do you expect this inventory will get over? Excess inventory that you are seeing from US Europe?
US Europe was pre-anti-dumping duty. The inventory has been built up. Difficult to say. We don't know the numbers, so very difficult to answer that question. But we estimate that probably in the next 3 to 4 months, that inventory should be largely cleared.
Understood, sir. Understood. And let's say, right now you said that vanillin price is probably $13 to $14, and assuming that 50% duty right now from US, so our landed cost would be around $20, $21, right?
Yes.
To the
And
customer.
Chinese, correct. And Chinese is roughly $28 at this moment.
Right.
And how much is the Solvay cost?
Costing, we don't know what, but they're selling, their selling market price is $20. And like I said, they're at 18, 19, but they'll probably take it closer to 25. Once the inventory is cleared, they don't want to obviously push in the market right now. So our estimate, they'll take it to about $25.
Understood. And let's say if the tariff, you said that by September, October, there will be, the new contract revision for the next calendar year. So let's assume that this tariff won't go away. This 50% will remain at least for next 1 or 2 months. Okay. And if that negotiation happens, then do you foresee, will there be any upward revision of the vanillin price, or you will maintain the price of $13, $14 for the next calendar year?
Very difficult to say at what point the tariff will go. So essentially, what we will naturally try and do is give them a price which is the delivered price, which will obviously take care of this 50%. So the pricing will be a little higher. So if it goes away, we get the higher price. If it doesn't go away, we get a lower margin.
But if 50% tariff will remain the same, you are saying that you'll revise the price upwards when the negotiation happens. Is that correct?
No, I'm saying that the price in the negotiation will be defined by what the competitors are doing. So Chinese will come in at $28. Solvay will come in at maybe 24, 25. I don't know what price they will come in at. So we have to see if we even land up at $20, for example, or $21. That is including the tariff. If the tariff doesn't come, we get the 21. If it comes, we'll get 40.
And let's assume if, by the end of this month, if there'll be more tariff on India, okay, and if your landed cost would go up to $25, and if the tariff doesn't go, then will there be any clause in the contract that if the tariff goes away maybe within next 3 to 4 months, the price would be revised afterwards?
No,
Is
I
there
don't
any
think
clause or the price would remain fixed?
Generally, these are fixed rate contracts.
Okay. Understood.
Anyways, it's all unprecedented. No tariff has ever been like this. So it's very difficult to say what people are going to do as a buyer, what their strategy will be.
And we don't know whether this is the end. Tomorrow morning we can get a tweet with 150%.
No, who knows? Or 0, or 15, or 20, or who knows?
Understood. And you said that by in FY 27, we are assuming 70 to 80% capacity utilization of vanillin. So how much of that, 40 to 100 tons, we are assuming the sales volume for vanillin. How much of that would go to Europe?
About 40% to Europe, 30 to 40% to US, and balance rest of the world.
Understood. And European contract would also be negotiated by September, October only.
Correct.
Understood, sir. And this quarter shutdown, was it there in the last year also, the same quarter?
It was in the year before last.
Understood. That's
You have seen the last quarter result where the plants were at full capacity and hence we had to take the shutdown.
Awesome. Sure. Thank you so much for answering all the questions.
Thank you. The next question is from the line of Kritin Arora from Stallion Asset. Please go ahead.
Hi, sir. Thank you for the opportunity. Sir, as you mentioned, some of the tariffs will be borne by the company. So what initial discussions with your customers suggest in terms of the ratio of tariffs that will be borne by Camlin?
The price is inclusive of delivered price to customer. That's what he's interested in. I explained this whole thing in the last question in detail.
The tariff has to be borne by the importer. So we have to send the material at his stock or at the doorstep in US, and he has to clear it. Custom duty is to be paid by nobody wants to share this cost, right? You can only adjust your selling price.
Got it, sir. Got it. Thank you.
Thank you. The next question is from the line of Rohit Nagraj from BNK Securities. Please go ahead.
Thanks for the opportunity. So you just mentioned that about 80% of our vanillin sales are coming from Europe and the US. How much of that is generally contracted and how much of that is on a spot basis?
So we'll look at probably a 50-50 mix.
And in the rest of 20%, do we feel that there will be a larger pressure in terms of pricing, given that all the Chinese players will be eyeing on this market and possibly even the volumes could be subjected to some challenge?
Yes, the volume is okay. The price will always be challenged by the Chinese. But since we have high purity, high quality vanillin, we have some opportunities in some high value added F&B products. So that's the market that we are targeting. We're not targeting the regular market. We're targeting very specific high-end consumers who require high quality, high purity vanillin.
Sure. Got that. So just last clarification. In terms of the current, tariff scenario, when we are, are we getting any orders from the U.S. market? And if we are getting those orders, are those backed by, advance payments, or how does it exactly work? Because we sell the material, if the the customer is not able to lift the material, will there be a risk of any payment cycle which may get elongated?
No. These are all multinational customers and very large customers, so that doesn't happen. If you've signed a contract, people generally in the West honor contracts.
Right. Got that. That's helpful. Thanks a lot and all the best.
Thank you. The next question is from the line of Jatin Sangwan from Burman Capital. Please go ahead.
Sir, our losses in China and Europe have reduced to around 6 crores per quarter now. So by when do we think that they will completely go away? And
So China should go away this financial year by the end of the FY 26. We should be by the end of the year. China will go away. Europe, we yet have to maintain the site. So there will be some cost of keeping that mothballed site, which we have said that our estimate is it will be about 2 crores a quarter in the next financial year.
But this financial year, we will have a similar run rate of around 5 crores per quarter on Europe.
Okay, got it. Thank you.
Thank you. Ladies and gentlemen, this was the last question. I now hand the conference over to the management for the closing comments. Thank you, and over to you, sir.
Thank you. Ladies and gentlemen, thank you for giving us your precious time, and I hope you were able to clarify most of what you wanted. Look forward to interacting with you again. Until then, goodbye.
Thank you. On behalf of Camlin Fine Sciences Limited, we conclude this conference. Thank you for joining us, and you may now disconnect your lines.